The next measurement next measurement model is revaluation model. Under revaluation model, property, plant and equipment is carried at fair value less any subsequent depreciation and impairment loss. Okay, so if we basically record our asset at PPE at revaluation model, it will be like revalued amount less depreciation now will be charged on that revalued amount, less at the year end if there is any impairment loss. If the revaluation model is adopted, then IAS 16 provides the following rules. You must follow these rules. Number 1, revaluation must be made with sufficient regularity to ensure that carrying amount does not differ materially from the fair value at each reporting date. This is very important. And this one statement is basically one of the MCQ in F7 financial reporting paper. I remember that revaluation must be made with sufficient regularity. Yes, of course. If an item is revalued, then entire class of asset must be revalued. If a revaluation increases the value of asset, the increase is presented in other comprehensive income. You already knew it, that the increase is reported in other comprehensive income, and that disclosed as an item that will not be recycled to profit and loss in subsequent period and held in revaluation surplus within other components of equity. Okay, now one thing I must clear you. We have a profit and loss statement. What is the end product of that? Profit after tax. You know, this is transferred to retained earnings in SOFP. And we have the other comprehensive income statement as well, which is transferred to OCE, other components of equity in equity. So in equity, we have basically share capital, retained earnings and other components of equity. All other reserves, including share premium, revaluation or any other reserves, are basically part of other components of equity. Okay, so OCI is transferred to OCE. Now what is basically the meaning of recycling to profit and loss? Anything recorded in OCI will be transferred to OCE, and upon the realization at which date that income is realized, revaluation, we will not transfer the revaluation reserve amount to profit and loss again. The transfer from revaluation reserve to profit and loss is called recycling. And you must know, this may be asked in question number 4, current issue topic, that which of the items recorded in OCI will be recycled. First item you learn which will be recorded in OCI is revaluation, and there is no recycling of this. So upon the realization of income. When we dispose our asset, then this revaluation reserve will be transferred to retained earnings. This is not recycling. Recycling means the gain which we recorded in OCI will be recycled to profit and loss again when that gain will be realized. So in case of revaluation, this gain will not be recycled to profit and loss. This gain will be transferred to retained earnings. Next, if a revaluation decreases the value of asset, the decrease should be recognized immediately in profit and loss unless there is a revaluation reserve presenting. Okay. If we have a cost 100, life 10 years, and fair value at year end 110. Now what is the net book value at year end? It's basically 100 minus 10, 90. And what is the fair value? 110. So 20 is revaluation gain, and that revaluation gain will be reported in OCI. But if at year end fair value becomes 80, what was the net book value at year end? It was 90. And what was the fair value? It was 80. Now this is called revaluation loss, and it will be reported in profit and loss. This is the normal situation. Now what happens if an asset previously revalued upwards and in current year it was revalued downwards? This situation is called reversal of revaluation gain. Basically, it was a gain in the previous period and the loss in the current period. So this situation is called reversal of revaluation gain. In current year we have a loss. So first the loss will be debited to revaluation reserve or OCI, and then excess will be debited to profit and loss. So suppose in 2011 we have a revaluation gain of 100 million, and in 2012 we had a revaluation loss of 80 million. How we calculate revaluation gain or loss? It's a difference between net book value at year end and fair value. Now this is our current year. So if we have a loss prior to which there were no revaluation gain, then loss should have been written in profit and loss. But in this situation, this asset has a revaluation gain the previous year. Now this loss will be first debited to OCI. So double entry we must record here: debit OCI 80 million and credit asset 80 million. Situation number 2, we have In 2012, revaluation loss 120. And in previous year we have a revaluation gain of 100 million. In 2012, loss exceeds the previously recognized revaluation amount. So first we will remove the revaluation gain, and that will be recorded in OCI. How much amount we already recorded? 100. So debit OCI. Debit how much loss we basically incurred in 2012? 120. 100 debited to OCI, then difference 20 will be debited to profit and loss, and credit will be asset. This is what we call reversal of revaluation gain. Similarly, there is another situation which is called reversal of revaluation loss. In this situation, we had in previous year revaluation loss, in the current year it is revaluation gain. So in that case, first we need to credit profit and loss, then excess will be reported in OCI. Suppose in 2011 there was a revaluation loss of 100 million, and in 2012 there was a revaluation gain of 80 million. Now here the gain is less than the previously recognized loss, then this whole gain will be credited to profit and loss. There is no excess amount. Excess means that if revaluation gain is greater than loss, debit asset 80 million, credit profit and loss 80 million. Situation 2, revaluation loss 100, revaluation gain 120. Gain exceeds revaluation loss. Now entry would be debit asset 120, credit profit and loss. The previously recognized loss will be debited in profit and loss. In order to rectify our entry, we will credit the whole amount which was previously recorded in profit and loss, and the difference and excess will be credited to OCI. Okay. An entity can apply revaluation model instead of cost model in accordance with IAS 8. Which standard allows us to apply IAS the revaluation model or change revaluation model to cost model? IAS 8. IAS 8 states that an entity can change the policy. This is called the change of policy. Okay. One thing you must keep in mind, that change of measurement model is change of policy. So IAS 8 allows, if you have two conditions, then you must change your policy. Number one, there is a change or revision in existing standard. Number two, change will improve the faithful presentation and relevance of financial improvement statement. That the change will improve the two characteristics of the financial statement. Now I discussed over here the two characteristics of financial statement which needs to be discussed in exam as well. Relevance. Why we need to convert the to basically move from cost model to revaluation model? Because it might be possible that it will improve the relevance of financial statement. Now what is relevance? Information is relevant if it has the ability to influence the economic decision if users is provided in time to influence those decisions. Materiality has direct impact on the relevance. You already learned the relevant cost, relevant cash flows. These are the basically cash flows and costs used in decision making. So you must think that the relevance is necessary for the decision making of the user. Any information which is not relevant will not help the users in making their decision making. Now, what are the qualities of relevance? Information provided by a financial statement needs to be relevant. Information that is relevant has predictive or confirmatory values. These two are the qualities of the relevance. You must discuss these qualities in exam. What are the qualities of the relevance? There are two qualities of relevance. One, predictive, and second one is confirmative. What is predictive value? Predictive value enables users to evaluate or assess past or future events. Confirmatory values helps users to confirm or correct past evaluation and assessment. What is meant by these things? If we have a plant, let's take another example. Because this concept is applicable at every level. We have a revenue of 100 million. Now, what user will basically do? He will basically go through the previous year's financial statement, and in that statement revenue was 90 million, and he basically analyzed that the revenue is increasing, and on the basis of this he can predict the future revenue, that it will be 110 or 120 or something else. So by providing any information, relevant information, we help the user in predicting his future values. Okay, so and the other thing is confirmatory. He can confirm this in the future, that what I predicted was actually achieved or not. Okay, so if we have a cost 100 million and 10 depreciation is deducted 90, so on the basis of this, user predict that in next year it will become 80, and in the next year he will basically predict that it is basically 80. So relevant information must be provided on which user can basically make some prediction that in the next year, if there is an increase in the value of the asset, then user is able to basically predict that future value will be increased. Second quality is basically faithful representation. IAS states that an entity change the policy if it improve the faithful presentation and relevance of. Now, what is faithful presentation? 5 to 6 marks question can be asked on this topic as well. Faithful in presentation. If information is to represent faithfully the transaction and other events that it purports to represent, they must be accounted for with their substance and economic reality, not merely their legal reality. We must disclose the information which is economic, which is in reality economic nature. We must not disclose the information of legal reality. Now, what is the difference between economic reality and legal reality? Suppose we take an asset on lease. Now, who is the owner of the asset? Lessor. But who uses the asset? Lessee. Then economic reality says that in the SOFP of lessee, this asset must be returned. What legal reality shows us that the party, that is lessor, owns this asset, then this asset must be recorded in his SOFP. But we will follow not legal reality, we will follow economic reality. Number 2. If there is no significant change in the value, then we can say that it is not recorded in a faithful way. For example, in the previous year, the value of the building was 100,000, and this year the value was 100,500. Now this is a very minor increase, so we must follow economic reality, and economic reality is that this is not a major or significant change from the previous year, so we must write this asset as it was in the previous year. Okay, but if you see that there is a significant change in the value of asset, then you must write it. Now who decides? It is basically, the value change. If we feel that there is a significant change in the value, then we must apply those values. Faithful presentation includes other qualities as well. What they are? Completeness, neutrality, and free from error. Information must contain all the necessary description and explanation. Why we are valuing our property? It must be clearly documented, because the value has already been increased. That's why we are basically revaluing our asset. Neutrality. Information must be neutral, that is free from bias. Third party valuation, any specific criteria must be triggered, must be applied. Free from error. Information must be free from error within the bounds of materiality. It must be free from error. So these two conditions, these two are called the qualitative characteristics of financial statement. Which two? The first one is relevance and other one is faithful presentation. These are the main qualitative characteristics of financial statement. I'll give you an example. Suppose you have a building in downtown recorded at cost, and you are basically now shifting to cost model to revaluation model. Can we do it? What accounting principles support us? Because in downtown, the value of property often increases, and if we record our property at cost, then it will affect the relevance of information and faithful representation. How? Its cost was 60, its revaluation amount was 120. Investor or user will make his decision making on the basis of 60, which is not his true decision making. So we affect the decision making of user if we are not able to provide him with the relevant information. Second one is faithful presentation. What is the economic reality? There is a significant change, so we must record this. And three components, what were the? Completeness, neutrality, and free from error. This 120 figure must be free from any error. It must not be biased. It must be complete. So if we apply these two qualities, then yes, we have an answer that we must shift from cost model to revaluation model. Okay, depreciation. The key principle with regards to depreciation are as follows. If a revaluation increases the value of asset, the increase is presented as other comprehensive income. You already knew it, I just told you. If a revaluation decreases, this I already told you. All PPE with the finite life must be depreciated. The depreciable amount of an asset is cost less is residual value. Okay. Residual value is an estimate of net selling proceeds. This is already what I told you. Depreciation is charged on the statement of profit and loss unless it is included in the carrying amount of another asset. It is very rare case. Depreciation is mainly charged in cost of sales or in profit and loss. Depreciation should be charged on each significant part of item separately. This is called complex asset, like aeroplanes, ships. In that case, depreciation is not charged on the asset as a whole. Instead, depreciation is charged on the component wise. Depreciation begins when the asset is available for use. This is what I already told you. And continues until the asset is derecognized, even if it is idle. Before ready to use, if it is not in the use, we will conduct an impairment test and not charge depreciation. When it is ready for use, we will start depreciation and will continue to depreciate the asset until its useful life, even if it is idle. Means if at the end of some months it is not in use, even then you will charge depreciation. Okay. Depreciation must be allocated on a systematic basis, reflecting the pattern. This is totally depending on the nature of the asset. For example, if you had a building, then building pattern is that it will give you a benefit on a constant amount, because it's a very slow depreciating assets, and all slow depreciating assets are capable of generating some constant income and constant depreciation. So we can say that we can apply straight line method on them. But there are some plant and machinery and vehicles, cars, etc., which are basically which produces income more in the earlier years than in the later period of their life. On those assets, we can apply reducing balance method. So it totally depends on the nature of the asset. Depreciation method based on the revenue generated by an activity are not appropriate. This is very important point. We basically should not depreciate the asset on the revenue generated activity. This is because revenue reflects many factors. Take an example. A plant is in the running condition, it will be depreciated irrespective of it is producing 10 units, 12 units, or company is selling 30 units or 40 units. So we must not depreciate the asset on the revenue basis. The depreciation method, residual value, and the useful life of an asset should have been reviewed annually. This is already told to you. Repairs and reconditioning. The cost of servicing and repair of PPE cannot be capitalized. These are the cost of profit and loss, repair expenditure. Some part of the asset may require regular replacement of asset. For example, the seats in the aircraft. The replacement parts should be capitalized. The replacement of the asset must be capitalized. The engine of the aeroplane is replaced, then this engine will be capitalized. So replacement of asset, replacement of part is basically considered to be a part of capitalization. However, carrying amount of the part being replaced should be de-recognized. But first, you de-recognize the part which you are replacing. For example, if we have an engine and that is being replaced by the newer one, then first we have to de-recognize that previous engine and then recognize the newer one. If the carrying amount of the replaced part is not known, then the cost of the new replacement cost can be used to estimate the cost of the replaced part when it was originally acquired. You can estimate it that if, for example, a very old part is being replaced after 40 years now. Now the question is, what amount you will de-recognize? And you don't know how much it cost, then we will assume that this asset is bought currently and we will depreciate it over 40 years and the remaining amount will be de-recognized. Some assets such as aircrafts can only be operated if regular inspections for fault are carried out. The cost of these inspections can be capitalized. Very important points. Without inspection, you cannot fly. So these inspection costs must be capitalized. Any remaining carrying amount relating to previous inspection should be de-recognized. Previous inspection costs must be de-recognized. This is the rule. If you recognize some new expenditure in the replacement of previous expenditure, then you must de-recognize the previous expenditure. So inspection cost, for example, you bought, if an aeroplane company, air travel company bought an aeroplane, then it must incur some inspection cost. That inspection cost will be capitalized. De-recognition. IAS 16 says that assets should be de-recognized when disposal occur or if no further economic benefits are expected from the asset use. The gain or loss on de-recognition of asset is the difference between the net disposal proceed and the carrying amount. When the revalued asset is disposed of, any revaluation surplus may be transferred to retained earning. This is also what I told you earlier. Last thing, disclosures of IAS 16. IAS 16 requires entities to disclose the measurement basis used to depreciation method, what depreciation method you use, on what basis you devise the useful life and depreciation rates, reconciliation of carrying amount. This is very important note. This may be asked in your exam paper. The reconciliation note. Now, what is reconciliation note? Brought down and carried down reconciliation. Now, the difference between brought down and carried down may be due to some new addition of asset, some new revaluation during the year. It may be deducted due to disposal. It may be reduced due to depreciation. So this opening value and this closing value must be reconciled. This is called the reconciliation of non-current asset or PPE. This is what IAS 16 requires from an entity to draft a note on it. That is called reconciliation statement of PPE. So here ends our first accounting standard. just hold on, just hold on. Okay, I was basically thinking to go through any other question, but I thought that I think I have given much examples to explain my points to you. So this was basically our first standard. Just go through it and see you later. Thank you.